If you have money in a traditional IRA and you give anything to charity, there's a rule that changes the math on both. It starts at 70 and a half, and almost nobody uses it because the form that reports it doesn't say what it is. Let me start with that part because it's the part that costs people money. When you take a qualified charitable distribution, the money goes straight from your IRA to the charity. It never touches your hands. Your financial institution reports that transfer on Form 1099-R, same as any other withdrawal. Here's what the IRS says about that form in their own words. There's no number or letter code on the Form 1099-R that indicates the distribution was a QCD, none. The paperwork that reaches the IRS shows a withdrawal, and nothing more. You gave the money away, and the form doesn't know it. So the entire tax benefit depends on you reporting it correctly on your return. Miss that step, and you've donated the money and paid income tax on it too. That's the trap. Now let me back up and explain what this thing actually is, because it's genuinely one of the better rules in the retirement code. A qualified charitable distribution is a non-taxable distribution made directly by the trustee of your IRA to an organization eligible to receive tax-deductible contributions. Two words in there are doing the heavy lifting, directly and non-taxable. Directly means the money cannot pass through your checking account. If your IRA sends you a check and you write your own check to the charity, that's not a QCD anymore. It's a withdrawal and then a donation, and those are taxed completely differently. Non-taxable is the point of the whole exercise. The money never enters your income. It isn't a deduction you subtract later. It simply never shows up, and that distinction matters more than it sounds, which brings me to why this rule exists in the shape it does. Most people over 65 take the standard deduction. They don't itemize, and if you don't itemize, a charitable donation gives you no tax benefit at all. You were getting the standard deduction anyway. The IRS addresses this directly on their page about QCDS. The taxpayer doesn't have to worry about meeting the standard deduction or itemizing deductions with a QCD. So for a retiree who gives to a church, a food bank, a scholarship fund, and takes the standard deduction like almost everyone their age, this is the difference between a donation that helps their taxes and one that doesn't. Now the age, because this is where it gets strange, you must be at least 70 and a half years old on the day of the distribution. Required minimum distributions, meanwhile, start at 73. I covered those in the last video. Sit with that gap for a second. Between 70 and a half and 73, there are 2.5 years where you can move money out of your IRA tax-free to charity before the IRS requires you to take anything out at all. 2 different ages, 2 different rules, and they don't line up. Then at 73, they connect. A QCD counts toward your required minimum distribution. That sentence is worth reading twice. If you own a traditional IRA, your required withdrawal is going to happen. The IRS has decided that. The only question is whether that money lands in your income or goes somewhere else. And if part of it was going to charity anyway, routing it directly means your required distribution gets satisfied and that portion never counts as income, which reaches into everything else I've covered on this channel. A smaller income number means less of your Social Security gets pulled into the taxable calculation. It means a lower figure for Medicare to look at when they set your premium 2 years later. One decision about where a check gets mailed touches 3 different systems. Now the limit's in the fine print, and there's more of it than most videos admit. There's an annual cap on how much you can exclude. And here I have to show you something because it's a good example of why I keep telling you to check dates on government pages. The IRS tax tip page about QCD says the maximum annual exclusion is $100,000. Publication 590B says $108,000. Financial institutions are currently telling their clients the 2026 figure is $111,000. All 3 of those can be right, because the limit is indexed for inflation and rises most years. The tax tip page is from 2022. At the bottom of that page, the IRS writes, in plain language, that news items may not be updated after their release, and that you should verify the date before relying on the language. That's the IRS telling you their own page might be stale. So for your tax year, the number to trust is the one in the current edition of Publication 590B, linked below. I'm not going to state a figure here as if it'll still be right when you watch this. If you file a joint return, your spouse can make their own QCD. It's per person, not per couple. Anything above the limit counts as income like any other distribution. Which accounts qualify? Traditional IRAs generally. QCDS cannot be made from simplified employee pension plans or savings incentive match plan for employees' IRAS, SEP, and simple accounts. And workplace plans like a 401k aren't eligible either. Money sitting in an old 401k has to be rolled into an IRA first, and that's a separate decision with its own consequences. 2 more rules that catch people. You need an acknowledgement from the charity, the same kind you'd need for any deductible contribution. Get it before you file. And if you've made deductible IRA contributions for the year you turned 70 and a half or any year after, your QCD exclusion gets reduced. The IRS calls this out specifically. Back to where we started. Report the full amount of the charitable distribution on the line for IRA distributions on your Form 1040. On the line for the taxable amount, enter 0 if the whole thing was a QCD. Then write QCD next to that line. A 0 and 3 letters. That's the entire mechanism that tells the IRS this money went to a charity, and there's nothing else in the system that will do it for you. There's also Form 8606 in 2 situations. If the QCD came from a traditional IRA and you took another distribution from that same IRA during the year, or if it came from a Roth IRA. Let me close on who this is actually for, because it isn't everyone. If you don't give to charity, this rule is not about you, and nobody should be talked into donating for a tax reason. If you take the standard deduction and you give anyway, out of habit or faith, or because you always have, this is probably the single most efficient way to do it. And if you're between 70 and a half and 73, you have a window most people don't know exists. Everything here came from the IRS's own page on charitable distributions from IRAS and Publication 590B, both linked below, with the caveat the IRS itself put on that first one. Check the date, check the current limit, don't take my word for it, and don't take a 2-year-old web page's word for it either. Next time, the survivor rules that decide what happens to a retirement account after the owner dies, and the 10-year clock most heirs don't find out about until it's running. Subscribe if this is useful. I read the rules, so you don't have to.